I wanted to approach a much broader issues in the market than just the Fed and the S&P 500 today. But I will touch on what Stan Fisher said and what I think is happening to the S&P 500. A month or so ago, I wrote a piece about the re-regulation of US banks. Before 2007, we had a circumstance where the US banks were really operating as principal in virtually every market. They were operating as principal in the mortgage market, and they were operating as principal in asset-backed securities, as has become well known. They were operating as principal in commodities, and this system worked really, really well until it didn't, and it started not to work in 2008. And then we were exposed to a circumstance in Australia which was really caused by a collapse of liquidity. If I look back at my standard model for the Australian market in 2008, what's really surprising looking back on is that Australian earnings were really, really good in that year. Commodity prices were high, oil prices were high. And in the world that existed up until 2007, you would have expected that Australian stock prices would have rebounded from an initial sell-off to reflect the level of earnings and bond yields. But that just didn't happen. What happened is that in spite of the fact that Australian companies were doing okay, Australian stock market prices collapsed. And that was because of the collapse of the level of wholesale liquidity coming in the US wholesale market that was being imported to invest in Australian shares. So it was a liquidity thing. Now, as the US banks were re-regulated and rebuilt, the normal level of liquidity that the banks could provide was lower. I said in the piece that I wrote some weeks ago, I showed part of a speech by Janet Yellen in which she showed how the increases in Tier 1 capital, which are the doubling of the Tier 1 capital of US banks, had resulted in pretty much their return on capital falling in half. But it's also a significant contraction of the activities of US banks that under the Volcker rule, they could no longer participate in things like commodities or totally control asset markets the way they did. And I said the result of that was that we had become much, much more susceptible to variations in liquidity in the US market. And the measure of this was the BAA spread, and it's shown in the quarterly institutional presentation. And as a result of that, what I was introducing was an enhanced model of the ASX 200, which included that. Now, right now, that enhanced model tells us that fair value in the Australian market is 54.60. And what's interesting about that is that it's about 300 points higher than the standard model based on earnings per share and bond yield. So what we are benefiting from in the Australian market right now is a surge in liquidity, which we can measure in terms of the narrowing of credit spreads, and that is what is driving markets up rather than the improvement in earnings of Australian companies, which really, including this reporting season, is still fairly miserable, I have to say. If you take it in total, it's compensated for by lower bond yields, but it doesn't justify the market being where it is. Now, why is that recovery in liquidity happening? I talked last week about the rise in operating earnings per share of companies listed in the S&P 500. And I said that from the quarterly operating earnings per share that we've just had, which gives us a full year operating earnings per share of about $98 a share, we anticipate that operating earnings per share for the S&P 500 will rise to about $134 a share by the end of next year, and that means that the level of operating earnings per share in the S&P 500 will go up by 35%. And I said that what was actually happening in the market was that the market now was anticipating the level of earnings in the first quarter of next year, so it would be fully justified in being at this level based on the expected earnings of the first quarter of next year. But by the time you get to the end of next year, if you fully discounted those earnings, then that fair value would rise to just under 2,400 points for the S&P 500, and so therefore there was significant upward pressure over the next year on the equities market. Now that increase in US earnings means that those corporations in the US wholesale market do not have to issue as much debt, and they are buying back their own debt, and that is generating a significant narrowing of yield spreads between corporate debt and sovereign debt. And our equity market is getting the benefit of that because we are getting more capital inflow from the US wholesale market, so that even though the level of our stock market at the moment isn't justified by the level of our earnings, it's justified by the level of US earnings and is driven by the capital flow being generated by US corporations to Australia. Now, clearly, this is a very optimistic view. I mean, it's a justifiably optimistic view of a much stronger market over the next year. But against that position, we have a situation where the Federal Reserve needs to intervene to control the real economy. And the real economy, in terms of the two most important variables that I've spoken about over the last year and a half, is the level of core inflation and the level of unemployment relative to the natural rate of unemployment, because that's how the Fed determines the level of employment rather than relative to the natural rate of unemployment. Is the way that the Fed determines has it achieved one of its objectives, and that is the US economy in full employment. Now, Stan Fisher is a very practical guy who I've seen present a couple of times now. And what was interesting about the speech that he gave earlier in the week is that he gave it in very practical terms. He said, most people don't realize that we have already achieved full employment. Most people don't realize. And he pointed out that the level of unemployment now at 4.9% is pretty much exactly where the natural rate of unemployment is, or where the Fed's target of full employment is. So we can go a little bit lower than that, but gee, maybe not so much. And he also said, as I said in my piece last week, that US inflation, particularly core inflation, is now really quite close to achieving its long-term target. He said it was in hailing distance of the long-term target. So what that tells you is that the Fed thinks that they will need to increase interest rates. I think they probably think they need to increase interest rates based on the summary of economic projections, which is the last survey that they've provided. I think they need to increase rates by 6 times by the end of next year. That is 6 25 basis rate hikes, and I think that is vastly more than anybody in the market could conceivably believe. I think the market probably believes that the next increase in rates will really be sometime in March. And the market is wrong. And so what you're going to get is, between now and the next year, in this very beneficial environment of increasing earnings and improving fundamentals, you are going to get a series of negative shocks every time the Fed hikes rates. I think those will be negative shocks in an improving structural environment. That is to say, I think that they will provide for the equities market the opportunity of bull market corrections. but because they are so unexpected, they will generate significant shocks when they occur.